Hello and welcome to another edition of Warwick Insights. Today I'm joined by Matt Dimos from Clarence Independent Finance Brokers. So we're doing a special video today purely based on interest rates, and I've invited Matt to come down and just share a few of his insights as to what's going on in the finance world. So welcome Matt, and thanks for sitting with us today.
Thank you, mate. Much appreciated.
So firstly, the big question, fixed rates versus variable rates. What's the better option? And in your opinion, what are the advantages and disadvantages of either of those options?
Yeah, it's a really hot topic. A lot of clients of mine will wonder which is the best way to go. Sometimes it's because they're trying to gamble on the rate, make sure that they're on the lowest cost possible for the near future. But also some people inquire about it purely because they're not sure if they can get offset with fixed, and so there's a lot of questions that come around fixed versus variable. It's a pretty unique market at the moment with regards to where the rates are sitting. Not always have the fixed rates been so much lower than variable. We're in a
because traditionally it has been that the fixed rate is higher than the variable rate. So
it can be sometimes the same
on that swap.
Yeah, sometimes the same. You know, there's a lot of factors that come into play when the banks are dictating pricing and determining where they should sit. A lot of people assume that the cash rate is directly connected to every rate that the bank offers, whether it's fixed or variable. So if they hear something in the news that the cash rate is 0.1%, doesn't sound like there's a lot more room for rates to come down, but in fact there's a lot of moving parts with cost of funding and where the banks are actually getting the money from to pass on to customers, and there's wholesale markets that they get it from overseas. There's a lot of money coming from Hong Kong and all sorts of places where they secure it. And so typically what a bank will do with fixed rates, and again it does depend on the bank because some banks are self-funded, they've got money to lend, like cash on their books to lend out, and some banks don't, so they'll get money from wholesale markets, and without sort of boring everyone with the detail, they would typically negotiate a rate, you know, for a 3-year fixed term with someone else if they're getting the money from somewhere else, and then they make their margin and they pass it on. So very disconnected with the cash rate, so to speak. That all being said, you know, a lot of people at the moment, most of my clients have a combination of fixed and variable. So if they've got a loan for the home that they're living in, we tend to see that that loan has been split into two, with a fixed component and a variable component. And the reason for that is because they're sort of wanting to take advantage of the best of both worlds. So, you know, reduce the cost as much as possible by having a low interest rate on the fixed side, and still retaining an offset account that you get with a variable, because of course you don't get an offset account with fixed. So there's a lot of restrictions that come with a fixed product. So, you know, splitting the two means that, you know, we get the flexibility of a variable and all the features that come with it. You can park your savings there, but also, you know, you get to enjoy the lower rates on the fixed side. And
I think, and correct me if I'm wrong, it'd probably be better if you're going for that variable rate, you've got to have a bit of cash saved up to make use of that offset account. Like if you've only got $10,000 in the bank, then you might be better off having 100% fixed.
Very true.
Because that interest rate is just going to be that much lower than the variable rate.
Very true. And, you know, sometimes people forget as well that, you know, what's their ability to save during that fixed term, you know, and so if you're thinking of fixing for a couple of years, well then, you know, what's your income look like versus your expenses? Do you think that you'll be able to save a little bit more during that time? And so there's a bit of planning there too, you know, and a lot of my conversations with clients when we're deciding on products is, well, let's talk about cash flow for a second, and that's going to dictate how we treat this or how we look at it.
Yeah, fair cool.
Yeah.
Fair cool. So we're hearing that the banks are going to be loosening their lending restrictions in the next month or so.
Yeah.
Has that translated into more people, you know, applying for finance? Like how are you seeing that section of the market?
We went through a roller coaster ride the last 5 years, the lending sector, and it was because the banks were sort of we're getting their wrists slapped, so to speak, by the governing bodies, so APRA and ASIC, and wanting to make sure that they were lending responsibly, It was a way for the government to control what was happening in the property market too, and this is really their main tool, is the banks and how easily they lend. Interestingly, the government at one point wanted to restrict lending, particularly with investors at one point, and we saw a lot of changes there, particularly with foreign investors. We saw a lot of changes there.
And even that had a direct impact on the property market at the time, which I'm sure people.
Yeah, that's right. If everyone remembers, maybe about 4 years ago. And interestingly now, we have seen the banks relax, but again, it's because of the guidance they're getting from the governing bodies. The banks want to lend, if it was up to them, they'd be lending as much as they've got, but they do have to be compliant with all the regulators. So that all being said, it definitely has loosened up the banking sector. Borrowing money to buy your dream home, or borrowing money to buy maybe your first or second investment, has become easier already. We're seeing that. Some lenders more than others, it depends on their risk appetite, and so then we've got to figure out, based on that client scenario, which lenders are best for them. There's a lot of that happening at the moment, and it really has put a lot of reliance on brokers too, and now brokers are the services are used more than ever before. But I would say that there's still a little bit more room there for lenders to relax, and there's definitely a lot of things being said in the news about the lending sort of relaxing even further. So we'll see where it goes, but we are expecting it to become a little bit more lenient. Yeah.
Good.
Yeah.
Now, just sort of shifting focus towards our investor clients. Would you say now is probably the time for the investors in the market to refinance if they haven't done so in the last few years? Because we have seen a drop off in rents in the last 12 months due to COVID.
Yeah.
So I think cash flow is probably very important to a lot of those people at the moment.
Yeah.
Are you seeing a lot of investors go through that process, or is it something that they should be made aware of to?
Investors, and people with investment loans really, copped it, for choice of a better word. The last few years, they were the ones that really felt the changes, particularly around interest only, and how hard it became just to have your investment loan on interest only. And it's such an amazing tool, interest only, to redirect cash flow to, a more appropriate place, whether it be your home loan against the home that you're living in, which is not tax deductible, and there's all the strategies around that which were compromised because of this. The interest only feature, and that has become easier to obtain now. The banks are happy to lend interest only more than they were years ago. So, and also that's reflected in the interest rates. The gap between principal and interest repayment, or effectively interest rates versus interest only rates, has closed up. It used to be at one point 1% difference in rate, a full 1%, and now really it's as close as 0.2 or 0.1 with some banks. In some cases there are banks that will actually charge the same.
I didn't realise it was actually that close now.
Yeah, it's tightened up quite a lot for investors. If you want to go interest only on the home you're living in, there is still a big gap there.
And is it difficult to, if you're an investor and you have an investor loan, is it difficult to go from principal interest to interest only? Because I do know some clients that reached out to me directly, said that they had problems doing that.
Yeah.
And in some cases, banks actually force them to redo an entire application for finance. Is that still the case, or have they made that a little bit easier?
It's still the case, unfortunately, that if you want to extend your interest only period or change the interest only for the first time, a bank will take you through a full application process. And we're seeing a lot of clients actually come on board at that point, because they've spoken to their bank and said, okay, well, we'll put an application through so that we can change the interest only. And for whatever reason, that particular bank said, we're not comfortable in doing so. We'd rather you start repaying that loan or continue repaying that loan. And a lot of clients will come to me and say, well, this didn't work with our lender, but it's the perfect application for many other lenders. So each lender has their own credit policy, and so the interest-only factor has become a real pain point for a lot of people, and has been a major driver in refinancing their debt to a lender that's happy to do it. And there are a lot of lenders that are happy to do it.
So I suppose the key learning there is to, if you're not getting it from your current bank, now's the time to be.
Yeah, it doesn't mean that you can't have it. It just means that your bank, for whatever reason, their credit policy aren't too happy about it. Yep. But there are plenty of lenders that are happy to do it.
Excellent.
Yeah.
Now, another question that we had prepared today is, we've had a few clients ask us about pulling equity out of their home in order to get a loan to buy another property, whether that be a holiday home or investment property.
Yeah.
Can you explain to our viewers how that works? How does one go about doing it?
In principle, there is, as your property is increasing in value, or as you're paying your loan down, you're building up equity, and equity is essentially the difference between what your home is worth and what is owed. So it's the net asset. If your house is worth $1 million and you owe $500,000, then you've got $500,000 in equity there. That equity can be really powerful. Sydney-siders have been very accustomed to using their equity and building it, and I guess it's only natural. In most cases, property is our largest asset. So we see that it's such a reliable asset class to sort of continue to build your wealth, and so buying an investment property is very popular. So using that equity in replace of putting a 10 or 20% deposit down in cash savings is what most people will do. And it also is a way to borrow 100% of the investment purchase price. So from a tax strategic perspective, it can also be a good thing to use equity in any way, even if you've got cash savings. So accountants love it. It means that you can claim more. So very powerful, and even what we've seen now, I guess we're filming this March in 2021, the valuations at the moment have been really strong, and it's off the back of the property market being so strong, particularly over the last 4 or 5 months. Correct me if I'm wrong. So the valuations have meant that there's even more equity now, and so clients that were restricted with savings or equity but had great incomes, that's opened them up to then be able to go and buy an investment property.
Yeah, and I suppose in terms of that equity growth, let's call it, just in this year alone, we've seen property values increase up to 10% already, and we're not even a quarter of a year down. So you're definitely correct. There is probably that extra equity in the properties now that people can draw on.
For sure. And during COVID, people renovated. So everyone's gardens look great. So so the valuations are reflecting all of that too.
Excellent.
Yeah.
All right, our last question before we finish off for today.
Yeah.
Cheapest interest rate you've seen?
Ooh, there's some crazy things going on, but I would say the cheapest one I've seen so far, with a lender that you'd actually want to do business with, is a 1.79, and it's available to most customers. So 1.79, it's getting really cheap. And that's an owner-occupied loan.
Right.
Yeah, not investment loan.
And is that fixed or variable?
That's a fixed rate, and that's what we're finding. All the rates below 2% are definitely fixed. And to our point before, that's why a lot of people are choosing to have some sort of fixed component in their debt. So it's cheap money to be had. It's almost free, not yet, but almost free.
Well, there's definitely some opportunities out there for people who want to take advantage.
Yeah, that's true.
Well, thanks very much for joining us today.
Thanks, David. Thanks for having me.
I might actually try and get you back on in about 2 or 3 months' time, just so we can see how things have changed and progressed over the year, and we can update our viewers as to where the rates are sort of sitting at that point in time.
Yeah, sounds great. Thanks for having me.
Thank you to everyone who's watching. Remember, if you're watching us on YouTube, hit the subscribe button so you get notified of all our future videos. Till next time, I'm David Frusina and Matt Dimos.
Thank you.
Thank you.